Hey, welcome back to Compounding Quietly. Mixing QLD and QQQI sounds like you've engineered a smarter version of Nasdaq exposure, but engineering complexity into a portfolio and engineering better results are two different things. A lot of investors find that out after the fact. Let's actually look at this clearly. There's a particular kind of investor who ends up considering this combination. They've been in the market long enough to understand index investing. They know QQQ. They've held it, watched it, and trusted it. But at some point, the feeling of good enough shifts into what if there's something better? So they start looking. QLD catches their attention. It tracks the Nasdaq 100 at 2x leverage. The idea is compelling. Same index, same thesis, amplified return. QQQI catches their attention next. A covered call ETF on the same index, generating consistent monthly income. That combination sounds almost elegant. Growth amplification on one side, income cushioning on the other. Split it evenly, rebalance every quarter, and let the two halves work together. It sounds like a plan that solves two problems at once. But solving two problems with one portfolio is usually a sign that neither problem has been fully resolved. The investor adding QLD wants amplified growth. The investor adding QQQI wants income and some downside cushion. Those goals are not complementary, they are in tension. When the Nasdaq rallies strongly, QQQI limits your upside at exactly the moment. QLD is delivering the amplified return you wanted. When the Nasdaq pulls back, QLD amplifies the loss, while QQQI's income only partially softens the damage. The blend doesn't neutralize those dynamics. It makes them harder to track and harder to stay patient through. There's also a subtler challenge. When the blend underperforms, and it will in certain environments, it becomes genuinely hard to tell whether the strategy is failing or whether you're experiencing exactly the conditions you signed up for. That ambiguity has a cost. It makes every underperforming quarter feel like a decision point. That's the tension at the center of this comparison. Understanding it clearly before building the portfolio is where today's conversation starts. Let's start with QLD and what it actually requires from you. QLD is a 2x leveraged ETF tracking the Nasdaq 100. On any given day, the index gains 1%. QLD gains approximately 2%. On any given day, the index falls 1%. QLD falls approximately 2%. The daily math is clean. The compounding math over time is not. The reason is volatility decay, and it's worth seeing in concrete numbers. Imagine the Nasdaq 100 gains 10% one month, and then falls 10% the next. After those 2 months, the index sits at roughly 99% of where it started, a 1% net loss. At 2x leverage, QLD would gain approximately 20% and then fall approximately 20%. After those same 2 months, QLD sits at about 96% of its starting value, a 4% net loss. The index lost 1%. QLD lost 4%. That gap is volatility decay. It doesn't show up in simple performance comparisons, and it doesn't announce itself. It compounds quietly against you every time. Markets move sideways with volatility. Think about what that feels like for an investor holding QLD through a choppy year. The index is flat. They expected double the return. Instead, they're down. The leverage did exactly what it was designed to do, and the result is still negative. That's not a failure of the product. It's the cost structure of leverage running inside the wrong market environment. In a strong trending bull market, QLD has historically rewarded patient holders, but patience is harder to maintain. When the position is negative in a market that isn't even down, QQQI approaches the same index from a different angle. It holds Nasdaq 100 exposure and sells call options against that position to generate monthly income. The income is consistent, typically, higher than what most equity income investors expect. But the cost of that income is capped upside. When the Nasdaq rallies hard, the calls QQQI sold get assigned above the strike price. Those gains transfer to the option buyer, not back to you. An investor holding QQQI through a strong bull year receives their monthly distributions and watches price appreciation trail the index significantly. That's not a malfunction. It's the structure working as designed, but it matters for long-term compounding. In 1 year, a gap in price appreciation is inconvenient. Across a decade, that same structural gap compresses. Ending portfolio value in ways that are difficult to recover from. The income didn't disappear, but it substituted for growth that would have compounded. Now consider the 50-50 blend with quarterly rebalancing. The rebalancing mechanic is, in theory, disciplined capital allocation. You sell the outperformer, buy the underperformer, and move gains across the portfolio every quarter. In practice, every rebalancing date arrives at exactly the wrong emotional moment. When Queensland has run up sharply and QQQI has lagged, rebalancing means selling the position that's working. When QND has fallen hard and QQQI has cushioned the drawdown, rebalancing means buying back into leverage. Think about a year where markets fall 20%. QLD is down roughly 40%. QQQI has held up. Better income helped, but total return is still negative. The rebalancing date arrives. To stay at 50-50, you need to buy more QLD. You're adding to a leveraged position that has dropped sharply. Mechanically, you are buying low. Emotionally, it feels like extending a loss. Most investors hesitate. They tell themselves they'll rebalance next quarter when things stabilize. But by the time things stabilize, the moment the rebalance was designed to capture has already moved. The investors who skip that rebalance aren't running the strategy anymore. They're holding 2 ETFs and hoping the original thesis still applies. Coming back to the original comparison, this is not a question of which approach is more sophisticated. It's a question of which demands you can actually meet. QQQ makes one demand: hold it through volatility without acting. The blend makes 3 rebalance on schedule, tolerate leverage decay in choppy markets, and accept capped upside in strong ones. Neither is objectively harder, but most investors find that one demand is easier to keep than 3, especially across a decade of changing market conditions. If your time horizon is long and you have no meaningful need for current income, the blend introduces friction without adding return advantage. Volatility decay works against compounding in sideways markets. Capped upside limits compounding in strong ones. Both of those forces exist simultaneously inside this structure. QQQ doesn't carry either of those costs. It asks only for patience. And patience, while it sounds passive, is one of the most active investment choices you can make. Every quarter, you do nothing where you don't sell, don't shift, don't second guess. Is a quarter the compounding runs uninterrupted. If your time horizon is shorter, or income plays a real role in your financial picture, QQQI has a legitimate place. But the QLD component only earns its position if you can rebalance consistently, not in theory, but on the specific date, in the specific conditions that will feel hardest. The investors who struggle most with this blend are rarely the ones who misunderstood the structure. They understood it. They just underestimated the weight of executing correctly, quarter after quarter, across a decade of different market environments. A sound strategy executed imperfectly is not better than a simplest strategy executed well. Most of the time, it's worse. The gap between planning and execution is where most of the real risk in this blend lives. The right portfolio isn't the most engineered one. It's the one whose demands match what you can actually deliver. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.